Broadcom, a big name in semiconductors and infrastructure software, just released their Q4 2024 earnings, and well, they're really making some noise. Don't forget to like and subscribe if you want to keep up with deep dives like this one. They absolutely crushed market expectations, reporting a massive 24.7% year-over-year jump in revenue, hitting a huge $14.92 billion. Analysts were only predicting something like $14.61 billion, so Broadcom easily beat that. And they also really blew past earnings per share estimates, with non-GAAP earnings per share landing at $1.60. Way higher than the anticipated $1.51. Okay, now let's talk about adjusted EBITDA, which came in at $10.08 billion. Just to put that in perspective, that's a big 4.4% beat over what analysts were expecting, and they pull it off with a really solid margin of 67.6%. So as you might imagine, the market reacted pretty strongly, sending Broadcom stock up by 8.7% to hit $195.11 right after those earnings were released. So what's driving this incredible performance? Well, CEO Hock Tan says it's all thanks to the huge growth in their AI semiconductor solutions and infrastructure software. We're talking a ridiculous 77% year-over-year growth in AI revenue, which reached $4.1 billion. And their infrastructure software wasn't that far behind, showing an impressive 47% growth to reach $6.7 billion. These numbers really tell us that Broadcom's strategy of focusing on these high-growth areas is really paying off for them. So what's next for Broadcom? Well, their projected revenue for Q1 2025 is $14.9 billion. Which lines up pretty well with what analysts are forecasting. But here's the really interesting part. Their projected EBITDA for Q1 2025 is $9.83 billion. And that actually surpasses analyst estimates, which were sitting around $9.51 billion. This really optimistic outlook suggests that Broadcom is confident in their ability to keep this growth going strong. And speaking of growth, if we look at their history over the past 5 years, Broadcom's sales have grown at an amazing 19.2% compound annual growth rate. And it's actually picked up speed recently in the last 2 years. The annualized revenue growth rate jumped up to 25.9%, which shows just how strong demand is and how much they've been accelerating. Analysts are predicting that this upward trend is going to continue, and they're forecasting a 16.9% revenue growth over the next 12 months. That really suggests that Broadcom's products and services are going to stay in high demand. But beyond just their impressive revenue numbers, Broadcom deserves some serious credit for their super efficient inventory management. Their days inventory outstanding, or DIO, dropped down to just 36 days. Now that is significantly lower than their 5-year average, which was 62 days. And what this tells us is that they're doing a great job managing their inventory, and there's no sign of any overstock, which is really a positive sign for how well they're running things. Broadcom's really strong Q4 2024 performance, powered by their focus on AI and infrastructure software, really shows how well they can adapt to the constantly changing demands of the market, and that puts them in a really good position to continue their success in the coming year. Make sure you like and subscribe for more deep dives just like this one. Let's take a step back for a second and kind of look at Broadcom's journey over time. They actually started out as the semiconductor part of Hewlett-Packard way back when, but they've evolved into this really big semiconductor powerhouse, a pretty diverse portfolio of products. So their business covers everything from wireless communications and networking to data storage, and then on top of that, they've got this whole infrastructure software side of things that focuses on mainframes and cybersecurity. So this strategy of spreading out their business across different areas lets them meet a lot of different needs in the market, which helps them spread out their risk and drive growth across all these different industries. And speaking of growth, let's take a little deeper into what's really fueling this big demand in the semiconductor industry. I think the biggest drivers for things like processors and graphics chips are these really big long-term trends that we're seeing. Stuff like, the rollout of 5G and the Internet of Things and all these autonomous driving technologies that are popping up. Plus, you've got all this high-performance computing going on in data centers, especially for AI and machine learning. I mean, all these trends are really changing the face of technology as we know it. And Broadcom is really smart because they position themselves right in the middle of these sectors, which puts them in a great spot to capitalize on all these emerging opportunities. But it's important to remember that the semiconductor industry is like any other industry. It goes through cycles. These cycles are driven by things like, supply and demand getting out of whack and the natural ups and downs of product cycles, like what we see in the PC and smartphone markets. So investors really need to keep those cyclical factors in mind when they're trying to figure out the long-term potential of companies like Broadcom. All right, so let's switch gears for a minute and talk about software. I mean, software is transforming basically every single industry these days, and that's creating this huge demand for tools that help software developers do their jobs better. These tools could do all sorts of things, like monitoring that critical cloud infrastructure and integrating audio and video features into applications and making sure that content streaming works smoothly. And because Broadcom is so focused on infrastructure software, they're in a really good position to meet this growing demand. Now, in the semiconductor world, managing inventory is absolutely critical. And one of the key metrics to watch is days inventory outstanding, or DIO for short. DIO basically tells you how much capital a company has tied up in inventory and how much they're affected by those ups and downs in supply and demand that we talked about. So in situations where supply is really tight, inventories tend to be pretty stable, which lets chip makers have more control over their prices. But on the other hand, if you see DIO steadily increasing, that can be a sign that demand is weakening, and that might force companies to cut back on production if those inventories just keep piling up. So this quarter, Broadcom's DIO is 36 days, which is actually a lot lower than their 5-year average of 62 days. And that suggests that there's really no need to worry about them having too much inventory right now. It shows they're managing things really well. Broadcom just had a fantastic Q4. They beat both revenue and earnings expectations. And on top of that, they're giving us some really promising guidance for the future. All of that makes them a company that's definitely worth watching in the semiconductor and infrastructure software space. So the fact that they're managing their inventory so well gives us even more confidence in their ability to keep things running smoothly. It really looks like their decision to focus on AI and infrastructure software is really paying off, and it's putting them in a perfect spot to take advantage of all these cool new technologies that are changing the world. But even though Broadcom had a really great quarter, we have to remember that this is just one snapshot in time. The real test for any company is whether they can keep delivering value over the long term. So we'll definitely be keeping an eye on Broadcom as they keep navigating this really exciting world of semiconductors and infrastructure software. Thanks for tuning into this deep dive. And don't forget to like and subscribe if you want to hear more about the companies and trends that are shaping our future.